least on a near-term basis, I think investors are short-sighted, Kelly, because I think most investors chased up the market because they really thought the Fed was going to be more aggressive, and that we were transitioning back into this nonsense of that bad news is good news and good news is bad news. And, our economics department are still looking for 2 rate cuts before the end of the year. I think the Fed probably does 1 to undo what happened in December. And then with the stock market hitting new highs, common sense would tell you that the Fed has to hold here.
Right,
earnings are pretty good.
Yeah, I guess, Brian, my question is, we were at all-time highs back in October when the 10-year was at 3.25, and we sold off sharply, but then the first quarter GDP number was fine. The data so far this month has largely been fine. I mean, is the Fed telling the market, hey, you should be at all-time highs for the wrong reasons, instead of it being like, okay, we can be up here with the economy actually doing okay and without the need for those cuts?
I think that's a great point, but I think there's this huge disconnect with respect to what happened in the fourth quarter. And if you take a look at how markets have been the last 12 months, we're up single digits. We're up 7%. The market's up 19.9% year to date because of what happened in the fourth quarter. And I think, the Fed raising rates in the fourth quarter in the face of decelerating global growth and the IMF becoming increasingly negative. I think that's been what the true story is that the U.S. is a home for stability, not only in terms of GDP, but growth. And I think that's the theme. And so on a near-term basis, again, Kelly, I think investors could say, okay, 25 basis points, great golf clap, and then sell off the market. And then we could have a nice rally at year end as the U.S. again continues to be the best house in a bad neighborhood, but really the most stable house in the world.
And Greg, we got a more reminder of that with the European PMI data today, the manufacturing numbers. I mean, in Germany, they were awful. They were pretty bad for the Eurozone as a whole. You have the ECB meeting tomorrow. You have people like Rick Reeder at BlackRock saying that the European Central Bank should start buying stocks. Shouldn't central bankers at this point be tamping down expectations of what they can do for the economy? It's not 10 years ago. We're not in the crisis anymore. I mean, why these extraordinary actions?
Well, to a kid with a hammer, every problem looks like a nail, right? And to a central bank, looking at any problem, they say, well, what are my hammers? I got rate cuts, I got bond buying, right? So the ECB is going to serve up more of what they've been doing in the past by lowering their key rate further into negative territory. And you're right, the European PMI data today was really terrible. The U.S. data wasn't that great either. The manufacturing PMI for the U.S., I think, was the lowest since 2009. That said, the broader U.S. economy seems to be fine. So that sort of brings up the question, well, why is the Fed going to cut next week? And a lot of it has to do with what's going on in Europe. I mean, to a great extent, you've heard Fed officials say they're worried not so much about the U.S., but about the global economy. And moreover, there's a growing sense there at the Fed that even if they think that the U.S. economy deserves an interest rate of, say, 2.5%, they can't allow the U.S. rate to get out of line with where it is overseas. So if Mario Draghi goes ahead and delivers more negative rates, that kind of forces the Fed's hand.
What happens then if the European Central Bank starts buying stocks? Is our Fed good? Well, we better buy stocks too. I mean, at what point is it really necessary that just because they're facing problems, how much is a European slowdown really going to hurt the U.S. economy? Is it enough to warrant, that we would have to respond to that?
I don't think you'll see the Fed buying stocks. I'm not even sure the Federal Reserve Act permits it, notwithstanding the likelihood of getting some tweets from a certain close watcher of the Fed, perhaps encouraging the process. No, I mean, I think it's really about the interest rate. If you listen to the stuff that, say, Rich Clarida, the vice chairman of the Fed, has said, he has said that there's a strong global component to where interest rates in the U.S. have to be. And the U.S. cannot allow its rates to get too out of line with where they are with the rest of the world. Look at the euro today. It's down a lot because of the European data. That, as I think you were saying, or somebody else was saying on the show, that's kind of like bad for U.S. profits. And in the end, it's bad for U.S. growth.